this next panel is, I like to think that this is a question. If you ever come to a blue screening, you're going to get the question of, how do you see yourself exiting? And to that last panel, if you say IPO, we're like, no way. No, that's not true. But if you're a fan of Stephen Covey, you know, one of his first principles was begin with the end in mind. So for startups, you got to think about how are you eventually gonna return the capital to your investors? How are you gonna get to an exit? So this next panel is all about that, getting to an exit. So take it away.
All right, well, we're excited to be with you this morning, and we also recognize that we're the only thing between you and lunch, so we'll get started with haste here. Look, I think that was a great lead-in. When we advise companies throughout their life cycle, we give them the same advice, to begin with the end in mind. And yeah, I've got great news today. The M&A markets are ripping, they're hot. There is a tremendous amount of activity. 2024 in the cybersecurity sector saw 405 announced deals, but particularly in the second half, there were 227 announced deals, which indicates that there's a tremendous amount of activity. And from our perspective, we've seen a really significant increase in pitch activity, people asking and inquiring about opportunities to exit. And so I think it's being led by a few things. Dry powder is at an all-time high, continues to be at an all-time high. Investors have to deploy capital, and there's a lot of fragmentation still in this market, and that makes it ripe for consolidation. So we're excited to talk about this today. My name's Eric Perek. I'm an investment banker with Ascend Capital Group. We are a boutique middle market bank, and would like to do maybe a quick round of introductions here, and then we'll jump into questions.
Great to be here. I'm Dina Berdichevsky. I'm with JMI Equity. We're a B2B software-focused fund that invests in the growth stage of companies. So think between 10 million of ARR all the way up to 100. And for the last 6 years, I've been focused on cyber. Probably the most relevant investment that folks here might know, because it's in our backyard, is Huntress, which we invested in the Series B and then are still involved today. So excited to share the learnings from that and how we think about taking your business to the next level.
Hi, I'm Paul Farrell. I have a company called Patter Holdings, which is a fund that uses the money that the family office and I made over the last 2 or 3 decades, starting firms and turning them around. And I also have a consulting firm where I jump in and help CEOs get to the finish line.
Good morning, I'm Lindsay Thomas. I am a corporate and M&A partner at the international law firm King & Spalding, based here in Tysons, Virginia. And my practice primarily focuses on representing buyers and sellers and other stakeholders in connection with mergers and acquisitions. And I also work with startup companies throughout their full life cycle, from formation through financings and then being there when they're ready for their exit event. And I agree, it's never too early to start thinking about M&A as a startup, so I'm really looking forward to this discussion.
And I'm DJ Palmer, Managing Director at Ascend Capital Group. I spend all of my time on software and technology, and spend a great deal of time in cybersecurity, public safety, and government technology. We focus, and I focus a lot on what I would say is really the core of software and technology investing and exiting. So think about businesses that are single digits of ARR up to 25 million in ARR. I personally have worked with companies up to 100 million of ARR in terms of exits, have worked shoulder to shoulder with some of the biggest private equity funds globally, like Insight Partners, Clearlake Capital, Genstar, among others. And so I think for me and for us, that gives us a really unique perspective on how we think about positioning businesses to receive or try to obtain a strategic growth investment, minority recap, majority recap, or a full sale exit. And so have a lot of perspectives from working with smaller businesses that are 1 million all the way up to 100 million.
DJ, can you talk a little bit about why this is relevant to this audience today?
Yeah, I think I think we're very data-driven. I'm a very data-driven person. So when I think about some of the stats that we've mentioned, there's roughly 1,500 unicorns. That means of all startups, technology-oriented, less than 2% make it there. So there might be one founder in here that actually makes it to unicorn status. 90% of all tech startups fail. 70% of those that make it past that fail within 5 years. And so thinking about that and thinking about the fact that, call it 2/3 or vast majority of cybersecurity and technology startups end up getting acquired before they reach 10 million of ARR. Starting with the end in mind, that is a process that I think some of you may already be in that zone now. Some of you may not even be thinking about it, but when you start getting to 2, 5, 7, 9, you start to be creating a lot of value that gets a lot of attention from strategic buyers and private equity and growth equity funds, where you have a very high likelihood and a high probability of getting acquired even before you reach 10 million of ARR. So that being said, I think the conversation we're having today is really relevant in light of probably the life cycle and the phase that everybody here is in, moving from startup to scale up and eventually an exit.
Paul, we had the good privilege to work with you on your exit at Nehemiah Security. Would love to have you just maybe tell us a little bit of the story of Nehemiah.
Well, Nehemiah Security, let me back up a little bit first. So I got into this game of investing and turning around companies. And after I left AOL in 2003, we turned around a team of people, turned around a $440 million firm. And then we went on and I acquired a big data business from VeriSign and sold it to Reed Elsevier. Coming out of that in 2015, my chairman, the head of the family office I work for, said, hey, you need to get in cybersecurity. And so we did a whole bunch of research and found a white space. And it was in board reporting at the time, which was a much needed area. We had a whole bunch of success. And at the time, we decided that to be acquired was the way to go because of the client base, the customers, and the things to go. And Ascend ran the process for us. But it's important because what I need to say is about processing is they brought to us 4 or 5 people, and then it was our job to figure out what's the best bet. And it's not always the highest price when you're thinking about you, your staff, and the people and the software in its future. So it was a great process, but every process, and I've done this 3 or 4 times, they're all a little bit different, and that's why it's good to bring along guides.
Well, for a lot of founders, the question comes up, what is the right time to sell? How did you guys make that determination at Nehemiah?
Well, first thing I'd like to say is you got to start with the end in mind, but also run your firms like you're going to hold them forever. That's the number 1 rule. Right. And so you're running a tight operation, you're doing everything right. Then the time isn't right either through the next round of investment you're looking at, the client base, the employees, and where you got to go. And then you make the decision, let's explore. And so it kind of you and the exec team knows it. Have you run the race as far as you can get it? And this is the next thing, which is one of the concerns. It's also the employees and what they're doing and how much money it'll take to get to the next phase.
Dina, you do a lot of growth equity investing. What's the optimal stage for you all to get involved in terms of the life cycle of a company? When should they start thinking about that?
Yeah, maybe I'll pull the curtain back a little on the investor thinking and take the position of value maximizing for the entrepreneur and the founder. So how we think, what we assign the highest value to is proof points. So when we think about what makes a good company, ARR growth, retention, velocity, sales efficiency, it's important to have 2 years or more of data points showing either improvement or telling the story. And once we have that, our underwriting becomes a lot easier. So there's things that investors can underwrite and things that they can't. Very often, we cannot underwrite product and market. You know the product and market better than us. What we can affect and work with you on is execution. So you don't need to have the most expensive CRO or the biggest BDR team. We can help you with that, and we'll underwrite that into the value. But we do need to prove out and see proof points of a good product market fit.
That's helpful. Paul, you mentioned running a competitive process. I think whether or not founders and investors are trying to sell the business or take on growth equity, in our experience, it's optimal to run a competitive process to not only find the best valuation, but also find the right fit. And so in our experience, competitive processes optimize all of those different elements throughout that those considerations. DJ, do you want to talk a little bit about how we create competitive tension in a process?
Yeah, I think when thinking about an exit, I'm always focused on creating scarcity of value and scarcity of time. Scarcity of value meaning we are establishing through positioning, and when I say through positioning, I don't mean smoke and mirrors. I mean understanding where the business sits within the market, its technology, its product market fit, the data that we can contextualize to tell a story, to make it positioned as though this is a one-of-a-kind asset, it is scarce, and there's a time component to it that this is going to trade. And I think if we create, and what is created through a process is scarcity of time and scarcity of value, there's going to be a lot of really exciting and special things that happen. What unfortunately happens is many times founders think that they can sell a business by themselves, or they can rely on their team to conjure up a couple different offers and then create a competition. That's kind of like me going to a physical therapist or a dentist or any other profession thinking I can do what they can do. But at the end of the day, there is a nuanced and there's a little bit of an art to establishing the type of leverage that you need to be able to maximize value in terms through those levels of scarcity. And so that is really kind of our goal going into it. And obviously that is created through bringing ideal strategic buyers to the table and private equity funds, which somebody like Dina doesn't like because she doesn't want to pay up for the business. But
Not exactly.
That's I think how we really kind of start to think about it.
Dina, you appreciate well-run processes, though, and so when you're participating in a competitive process, how do you think about differentiating yourself as an investor in your firm?
Yeah, and I think while on one hand it does drive up price, on the other hand it does create really important touch points, and it allows us to show how we're different. So the way that JMI does this is we're very thesis-driven investors. So we don't have a ton of companies that we're thinking about or spending time with at once. We pick our spots, and that allows us to go very deep. So by the time Ascend has the mandate, we have already thought through what are the 3 or 4 things that we can help with, what's our value creation plan, how do we communicate that to the founder and show them that we can actually go help and execute on this together. And if we can't do that, then correctly we will not be competitive in the process. So we think about it less on a price and more on relationship, more on can we lean in and actually pay that price.
That's a great point. Lindsay, we often think of advisory roles in processes as being kind of a team sport, and it's always great to work with other service providers, attorneys, accountants, et cetera, that can add value through the process. How do you add value through a competitive process?
Yeah, great question. I mean, there's a lot of areas during the process where you can really lean on your outside counsel to help through navigating everything. One area in particular that Paul started talking about is you're going to get several offers, and a lot of times it's easy to get caught up in the purchase price, but as you said, that's not the only part of the deal. And one thing that we can do based on all the experience that we've had is really help you to synthesize and analyze the terms that are coming in. You know, a lot of times there is that dollar amount on the term sheet, but there's a lot of other components that impact the economics and what's ultimately going to go to the stockholders at the end of the day. And so we can be there, and you can rely on the experience of your attorneys to really help you think holistically about those offers so that you are evaluating the buyers on apples-to-apples basis and making a good decision.
As a follow-up, Lindsay, one question we get asked a lot is from founders and entrepreneurs is, at what stage should I engage with the advisors if I'm thinking about an exit in the future? You know, what's the value of having a long-term relationship for a client with you all?
Definitely, and I'm a little biased because I am an attorney here, but I think it's never too early to start that long-term relationship, especially if you can find an attorney who does both M&A and startup work and understands how startups work. Having that long-term vision and being able to have an advisor who helps you to think strategically about where it's important to invest in legal spend to preserve the overall value of your company. So if you have that long-term relationship, you can make sure that along the way, you're spending a little bit to do things like make sure your IP protection is all buttoned up and having good capitalization records. And if you do that along the way, when you are ready for an M&A event, it's going to be much cleaner, much smoother, getting everything together. Now, you can fix a lot of those problems when an M&A event comes, but I'm going to tell you it's much more expensive and much more difficult to do that. So if you have that trusted relationship throughout your life cycle, I do think it's very beneficial.
DJ, from your perspective, you know, at what stage should startups or early stage founders start having conversations with a banker, and what advantage does that give them?
Yeah, I don't think there's ever a situation where it's too early, because I think even if you're at $500,000 of ARR or $1 million of ARR, I think starting to get a sense for where do my KPIs sit in comparison to my peers? How do I think about am I on the right track in terms of where my sales velocity is going? How do I think about my CAC payback, or how do I think about retention today in comparison where it needs to be? Is the valuation I think I'm at actually where it should be? I just did a raise and my post val was X. If I were to sell tomorrow, what does that actually look like? And so I think there's a little bit of like soundboarding, really trying to understand, hey, in light of where I am today and knowing an exit is imminent, let's start to think about, again, where are you today? Where are you from a KPI standpoint? How are you thinking about the platform and the product roadmap? And, you know, some stuff like, you know, I think founders have a pretty good sense and innate ability to kind of pick the swim lanes where they want to stay. But I think other ones, you know, it's never too early to have somebody like an attorney or a banker or somebody else start to give feedback, because there's always blind spots. And I think it's really good to understand what are the blind spots that you're unaware of from day one, so that an issue today doesn't become a bigger issue in the future. And, you know, you're at the point where now I've got to exit and I didn't take care of a golden parachute clause, or I have a huge options problem, or, you know, we're dealing with implementation issues and my VCs are forcing me to exit, or we're underwater. I think the earlier you can start to have those conversations and just start to prepare, it's going to be really, really helpful down the road, because we've seen just really painful events from founders where they haven't done that earlier.
Dina, you all are thesis investors, and you start developing and cultivating relationships within that those theses early on. At what stage do you start having conversations with earlier stage companies, and what's the benefit to them to start talking to you and developing that relationship early?
Yeah, so we think about our sales cycle as 5 years at the minimum. So as you can imagine, we're starting to talk to companies very early in their life cycle, probably 3-4 years out before we would be the right capital partner fit for them. And the reason for that is, and I think from the company's point of view too, it allows us to be taken on the journey with them. So at every time that we have an interaction, we learn about how their execution has gone over that year. We see how they've thought about certain problems that we've discussed. And what this allows is kind of a two-way diligence, right? It's really hard to figure out if someone is aligned with you philosophically on how to run the business in 1 hour management presentation during a process. If you figure that over the course of 2-3 years, you just have so many more data points to figure out whether or not you two are a good mutual fit, right? We think about it as a marriage. People have probably heard that before, and it's true. I mean, right? You're going on a 5-10 year journey together, even if you're doing a full or partial exit.
What percentage of companies that you invest in would you say you started a conversation with more than 2 years prior to the investment?
I don't have the stats, but probably it feels like 85%.
Pretty high. So I think for any startups in the room or early stage founders, it behooves you to take the call, to have the meeting, to start the conversations earlier than later, and start getting on the roadmap, start proving out those data points that investors are going to need as they go to their committee and start tracking your progress over time. And then, you know, DJ, do you want to talk a little bit about how we can use those relationships within a competitive process to make the process even stronger on an exit?
Yeah, and I think Dina raises a good point because, and I think the one thing that I would punctuate for a lot of founders and early stage companies in the room is that every interaction is an impression that you're making on somebody like Dina or a buyer. And so not too dissimilar from the analogy of marriage, right? It's like dating. You're making a first impression with a fund, you're making a first impression with the buyer. And if your story and how you're thinking about things is not buttoned up, it is probably going to create some uncertainty on, you know, does this founder actually know what they're doing? Do they have a good vision for where they want to take the platform? Are we philosophically aligned on how we think about the world? And so I think every one of those opportunities to engage with someone is a first impression moment, and it can really go a long way, or it can really hurt the relational equity that you're trying to build. And so I think being able to know that going into those conversations will help to start really build the momentum going into a process. Because if you've had 30 conversations with 30 different funds and you've just kind of like shot from the hip, it's going to probably not do you very, very good going into a process when you've got a bunch of people that think there's a good chance we're about to start speaking with a founder that doesn't really understand their market, doesn't understand where they want to go. So I think, again, to Dina's point, the more that you can have really rich, buttoned up conversations, that can really help going into a process.
Can I add for you?
Yeah, Paul, I was going to ask,
Let me add
your
first.
perspective, because you talk to a lot of different...
It's so critical. Long-term relationships are so critical because when I work with people that are around me, they see that you do what you said you were going to do. So like at the 6-month check-in, they're like, oh my God, you guys are doing a lot better than we thought you would. And this happens over a couple years. And that's where relationships are founded, right? When you know somebody over time, you can be more vulnerable, you can be more transparent. You can say, look, we've got a wart right here and it's really big and ugly, but we're going to do this to fix it. And then these people around here and all factions, they know how to help you fix it. Like, let's do this. I've seen this before. I've tried this. And that's by bringing a community together to help you make a sale. And I think the most important thing is knowing you over time and then doing what you say you're going to do. Because if they come in 6 months and you said you're going to do X, but you're all the way back down still on B, not even at X, it's not going to go well in the long run.
Yeah, we talk a lot about within our processes, but even before we start running a process, everything is about building credibility so that you've done along the way at all the checkpoints or all the discussions that you have, every time you talk to a fund and they check in every 6 months or whatever their cadence is, you can say, hey, we talked about this 6 months ago and now we executed it, or this is an update of where we're at, or that didn't go the way we think is planned. You don't have to get everything right. You don't have to, you're not gonna get everything right, it's a guarantee. But just building credibility along the way that you're thoughtful about it, that you're taking action, that you're not sweeping things under the rug, goes a long way to developing that long-term relationship, and it's gonna definitely lead to better outcomes along the way.
One more add on that, the investor also needs to build credibility with you. So if they're promising intros, access to their operational team, market studies, competitor studies, they need to follow through on that too. If they're not doing it early on, they probably won't later either. So it's a good time to also figure out, who do you actually like, who do you trust, who do you want to work with?
I think that goes for bankers and attorneys too.
Yeah.
Right? I mean, you know, you're the team of advisors and people you're surrounding yourself with should be adding value to you throughout the entire life cycle of the relationship. And you know, one of the things we take a lot of pride in is we are in a very transaction-driven world, but try to take a very relationship-oriented approach to that. That it's not just about what happens black and white in the transaction, but it's about all the other things. Have you done your estate planning? Have you set yourself up? Are you thinking about QSBS? You know, all these other things that go into maximizing the entirety of the situation is super important. And if you're not getting that type of advice and guidance and those types of introductions from your bankers, from your accountants, from your attorneys, from the sponsors you're talking to, you should absolutely check that off as a red flag. Paul, what do you wish you knew as you were scaling your business that you think would have helped position you better, that you would have done differently with Nehemiah?
That's a really hard question because, you know, it was a successful exit. So you're like, okay, but you could always do better. And I think that we focused a lot on employee acquisition, and I think it's critical. And I even think now it's even more critical. Give me 3 really good people instead of 10 people that are marginal. We focused on it a lot, but we could have done better. That's one thing. Cash flow management is always key. You know, we did early on a couple of small tuck-ins that I probably shouldn't have done. And that just wasted a few $1 million of capital along the way that I should have kept for later on. So those are the 2 things I would say, you know, but it's tough. It's tough out there, you know, and that's why it takes a community. And even after you sell, you need this community, right, for advice and transitioning to the next thing. They know a lot of people have been through it. I encourage you to talk to people because when you sell, and it's happened to me, you know, more, I've been very blessed by God 3-4 times. It's lonely that 30 days after when you're done, you know, you're not calling all the shots.
Dina, for you and DJ, I'd love to get your perspectives on this, but are there certain KPIs or guidelines that you look at when you're making investments, or DJ that you're seeing when you're representing companies that you're hearing from?
Yeah, maybe I'll go first, and then I'd love to get Dina's thoughts. I think we think about it in terms of quantitative and qualitative items. On the quantitative side, I think hopefully most folks have heard of Rule of 40. I think Rule of 40 is becoming now more like Rule of 60, and that means if you were to take your CAR or ARR growth rate and add that to your EBITDA margin, that number should exceed 40%, or in reality, 60%. And really, that's a metric to help investors understand that you can grow and balance profitability as you're growing. And so I think that's a really important metric that we see often. Certainly retention in terms of logo, gross dollar, net dollar, that package of retention metrics is probably one of the top 5 kind of, gold star items that everybody looks at. And when we talk about logo retention, we're talking about not month over month are you looking at retaining customers. If I were to look at where my customer base is today compared to 12 months ago, how does that look? And I would say most often, if your logo retention is below, call it, 90% at a minimum, that's usually probably some sort of flag. I think some investors can maybe get comfortable with 80s, mid to high 80s, but I think that's one element, net dollar retention, specifically in terms of if I look at upsell, downsell, churn, is that in excess of 110%? And I think if you look at like Snowflake and some of these other ones that are public, you'll start to see that theirs are pretty ridiculous, but multiples are justified because their net dollar retention is so phenomenal. And so retention is really big, but one of the things we've seen a lot is that retention needs to be supported by usage data. If people are using the platform, or if customers are buying the platform but not using the platform, that's a problem, and so that needs to go hand in hand. I think Dina really kind of hit on one piece earlier, which is the sales velocity. And when we talk about sales velocity, what is your ARR scale? And if I were to look at my pipeline and my go-get, is that bridging to a level of credibility that you could stand behind to be able to say that yes, if I'm positioning somebody to bid or to submit a valuation off of a forward-looking number, that it substantiates that. So I think those are a number of the ones that I think we tend to see. Obviously, geographic concentration, industry concentration, those things are always going to be, bugaboos, if you will. And I think the more you can start to de-risk and the more you can start to look at the KPIs and financial profile of your business earlier and start to orient around a dashboard, I think that's going to really help you as you continue to build the business. And then when I think about maybe some of the more qualitative stuffs, when we think about AI, which obviously everybody's, we've got a lot of organizations that are either trying to implement AI initiatives or have some sort of AI strategy. I think the big thing that we continue to hear is that LLMs are commoditized, data is king. If you have proprietary data and you have a complex deployment for your AI, that is going to add a huge moat to your platform, and that's going to have immense value. And when I say complex deployment, I mean like multiple modality capabilities, like it's continuous learning, computational power. Like it is complex on how it's deployed versus OCR, chatbots, like pre-programmed sort of like that is something we continuously hear. I think things like tech debt, avoiding and we've seen it, like I'm writing in COBOL, like tech debt is a huge issue that we continue to see. And so I think on those areas, building an infrastructure, a team, establishing product market fit, all of that works in harmony to, I think, really cast vision for someone like Dina or even an IBM or a Cisco on how they think about the world. And it's not just, again, one specific data point or one specific item on product. It's all of this stuff in harmony. So I'll pause, and Dina, you can tell me what I said and did wrong.
No, that was all correct. And what we do after we get that data from you guys is we distill it down into 3 categories, which then we report back to our investment committee, which is differentiation. So why do you win? It's moat, meaning how many new folks are starting the exact same company every year and can possibly become or create an extremely competitive environment and ecosystem, thereby bringing down win rates, increasing spend. And then the last one is nice to have versus need to have. How mission critical is this piece of software? Is it going to go away the second that security budget gets cut? Or is it critical for maintaining making sure that you do not have employees clicking on, malware. So there's a lot of things, a lot of KPIs that exist, but really they're all about fitting it into those 3 categories so that we can create a thesis.
Makes sense. Dina, are there any specific red flags that you run into in processes that cause you all to not bid?
In processes?
Processes, or even when you're just evaluating opportunities with founders?
I would say it's less so of a red flag, but it's a required green flag, but team. We need to be really comfortable with the team. I think a lot of the best cyber companies we've invested in have come from practitioners, so there's a lot of ethical hackers that we've invested behind. So that's probably the number one. And the number 2, I would say, is, I think cyber is a space where you can find yourself kind of in a leaky bucket of spend because there's a lot of vendors, it's a very big market, and there's a lot of noise in how people market themselves. And so what we look for are folks who have found a seam around a very specific persona they're selling to, a very specific product or problem or workflow that they're solving, and making sure that we can see this team then adding another product or a second act. So that's how we think about cyber specifically. Red flags, I think it's more about finding the green flags.
That's great. Lindsay, when you're advising clients in, let's call it the diligence phase of a process, what are some red flags that you're running into regularly that you could have avoided on the front end?
It's a good question. On the legal end, some of the bigger red flags that you'll find are just issues with capitalization, sometimes not tying it out correctly. There may be an issue with options or something along those lines. And a lot of times, those issues could have been mitigated and even corrected completely if you had spent a little bit of time in the pre-diligence phase working with your attorneys to do that tie out. And in my experience, if you can do that before you go to market with the buyers, I think it presents a much better, you're putting your best foot forward, and it gives the buyers a little more confidence. When you go into a clean data room where everything's laid out, I think it just makes the process a lot smoother.
Yeah, it goes back into that credibility piece, right? That you definitely don't want to lose credibility on those things that are absolutely within your control. Let's do a quick lightning round. I would love to know, Paul, maybe start with you. If you had the best piece of advice you could give to a founder today in this journey from startup to acquisition, what would it be?
I think it is being genuine, being transparent, and working with integrity. Because you just reminded me of a deal that I spent over a couple $100,000 on and got at the last minute because when we dove into all the contracts, there's tons of stuff they didn't tell us about, and I walked the deal on that. So integrity is really important.
Dina?
I would say leverage your network and your potential investors, advisors, make them work for you, make it mutual, but investors very oftentimes have done a full market study before they've reached out to you. Ask them for it, Get the advantage of folks wanting to talk to you.
Lindsay?
I would say strategically investing in legal protections throughout your life cycle is going to help to protect the value of the company and prevent a lot of headaches, as we talked about, once you're ready for an M&A event.
DJ?
Yeah, I would say, I think maybe piggybacking a little bit off of Paul's remark, I think staying humble, I think there's a lot in that. We've got a lot of smart people in this room, and I think it's easy to miss the forest through the trees. And so I think staying humble, staying hungry, and surrounding yourselves with the right people. And I think always just being a sponge, knowing that there's always more to learn, there's always more areas to grow and to get better as a founder, as an executive, and even as an investor. And so I think it's a simple truth, but I think that's going to go a long way in the journey. So
That's great. Well, we have a few minutes left. We would love to open it up for questions if anybody has them. We've got a couple mics that are going to be up here. If you want to just maybe raise your hand if you have a question, we're happy to to take it. Anybody on the panel?
Hey there, great panel. So I have a question that I've run into a lot recently. I have a $20 million ARR bootstrapped company, and we have a managed detection and response service and a pure product-based piece to it. Most of the folks that we've talked to in the spaces that you guys represent don't know how to distinguish separate valuations, because there's a EBITDA driven and then there's a valuation driven. And it gets really confusing for folks like me who have to negotiate the PhD level economics that comes with all of this stuff. So, what ends up happening as a founder is you get discouraged and you walk. And then you're so help me distill that down and how you think about a company that's not just selling the easy SaaS button or AI agent. What's the more real business that has multiple good things going on? So that's my question.
It's a great question. You want to take that?
Yeah, I have a lot of empathy for what you're talking about. I've seen it happen before, and I think as the founder, one thing I would maybe suggest you do is figure out how to position this MDR business so that it makes sense with the SaaS company. So for example, is it a funnel? Is it a sales motion for you? Is it sort of like a very high EBITDA implementation service that you have? Does it differentiate you from other, I don't know if the SaaS product is EDR, and figure out what the thread is between the two and flip it as a positive, because if it is what is differentiating you, then you should get value for that, and the investor, if they're a cyber investor, would understand.
Yeah, and I'll add on to that, because I think this goes back to positioning, and positioning is just so important when you think about it, right? Because that could potentially be a cross-sell avenue for a potential buyer. And so I think sitting down and understanding, okay, what areas of the business do we need to simplify the complexity of it, and then what areas do we need to basically start to think about, well, there's a ton of growth opportunity behind both sets of businesses or both business units, and how do we start to position this to certain buyer segments to communicate the true value of what you're holding, right? Because I think if you just look at the business from a biographical standpoint and say, here's where we've been, here's where we are, here's what it is, and we miss all that, buyers are going to get confused, people aren't going to know how everything fits together, and you're going to get frustrated and disappointed. And so I think it's going through that exercise to really kind of sit down and think through, okay, here are the buyer categories that we anticipate. How do we see this fitting within those buyer categories? And what are the growth levers behind it that we can unlock the value for the buyer? And so I think that's probably one of the areas that I would probably start.
Other questions?
We'll have to go quick.
Yeah, of course.
Hi, everyone. My name is Maria Velasquez. I'm one of the co-founders of the Cybersecurity Marketing Society. My partner and I are here to network, but really just raise awareness that we exist for VCs and for startups as a resource for their marketing teams. I heard community from you, Dina. I heard sales velocity from you. I haven't heard marketing yet. Where in that life cycle do you come in and help your founders with a solid GTM strategy and support in hiring their marketing team and their first key hires?
I'll defer to you, because I think that tends to be probably one area of opportunity that you see in a lot of deals that you invest in.
Yeah, I would say if you look at all of our materials and all of our VCPs, up at in big bold letters, nearly every single time it's product marketing, specifically product marketing, not just marketing, but how are you positioning your product, your battle cards? And in cyber, it is the hardest thing. So getting the right person in that seat sort of turns around your entire go-to-market. It's probably more important than even a VP of sales for some of these companies. So I'd say you're right, and you should do it as early as possible. I mean, after you found product market fit, so you know what you're marketing, but before you really start investing a ton of money into BDRs or, top of funnel, paid advertising.
Any other questions? Probably have time for one more. If not, I think that's a wrap.
All right.
Thank you all for your time.
Thanks.
We'll turn it